Let us start the discussion on 25 most important questions and answers on valuation of a company. Let us go to the first question now. The first question is here. Please note that these questions will be almost in the same order in which we would have entered our numbers into FCFF and FCFE valuation models. Therefore, even as we discuss these questions, we will understand the theoretical underpinnings of all the numbers that we are entering. Therefore, understanding these concepts will help you analyze what you have entered and what you have got as an output in your report. So here is the first question. Operating income is defined to be revenues less operating expenses, that is EBIT, and should be before financial expenses, that is interest expenses, for example. Therefore, we call it as earning before interest and taxes, and capital expenses, which create benefits over multiple periods. In any case, capital expenditure is not recorded in income statement. Therefore, EBIT or operating income is before interest expenses and capital expenses. Specify at least two items that currently affect operating income that fail this our definitional test. There are two items which do not come within this definition that we have given to the concept operating income. So, and explain what you would do to adjust for their effects. And we have done that, okay? So in our FCFF model. So let us try to know what those two items are, and then we will go to FCFF model to understand how it is done. We can go to say the next slide and then come back to the valuation input of FCFF model. Okay. The two items that most directly contradict this definition of operating income are operating leases and R&D expenses, both of which are categorized as operating expenses. Operating leases are financial expenses and R&D expenses are capital expenses. To correct the operating income, we have to do the following. Let us go to the next slide. So R&D is considered by accountants as capital expenditure. Okay, but we have to adjust it in the valuation of a company to consider it to be R&D is considered by accountants as the say revenue expense. Okay, but in FCFF valuation model or while valuing a company, we have to treat it as capital expenditure. Similarly, operating lease expense is considered as an operating expense, but we have to convert it as the capital expenditure. Okay, so how do we do that is what we are going to discuss now. Take the present value of operating lease commitments using the pre-cost debt of the firm as discount rate and treat the present value as debt. The operating income. Now, what is the meaning of this? Let me repeat that sentence and then we will go to the operating lease converter. Take the present value of operating lease commitments using the pre-tax cost of debt of the firm as a discount rate and treat the present value as debt. So we are converting operating lease commitment as debt. The operating income has to be adjusted by adding back the operating lease expense and subtracting out the depreciation created by the operating leases. Let us see how our valuation models of the corresponding Excel templates do this work. Okay, so let us first go to the operating lease converter. It is there in FCFF model. If you scroll to the right, you will get it. operating lease converter. Now, what are we doing here? First, we have recorded operating lease expense of the current year and operating lease commitments of the next 5 years and from 6th year and beyond. And then we took the pre-tax cost of debt. Okay, this pre-tax cost of debt was taken from synthetic rating Excel template. Okay, can you scroll down and show the output? Okay, whatever is shown in the yellow is our input. Okay, so now taking this Excel template has converted all our commitments into debt value by calculating their present value here. From row number 22 to 27, you see conversion of operating lease commitment for the first 5 years and from 6th year and beyond into their present value, and adding up all the present value as debt value. Okay, so operating lease expense commitment is considered as debt value. That is what we are supposed to pay in the years to come. That is our rent that we are supposed to pay. Okay, what is the best example for this? There are many airline companies in our country. They are operating Boeing aircraft, for example. They may not have purchased these aircrafts on their own, because purchasing one aircraft is requires huge amount of capital expenditure. A small number of aircrafts that they are flying may be actually owned by them. Others, they must have taken them on lease from companies such as Boeing, okay, which is an American company, aircraft manufacturing and leasing company. And every year every month they must be paying some rent on the amount of this aircraft. Okay, so for the next years and that lease will have a certain period of time. In say profit and loss account, it is treated as operating expense. Okay, but it is actually debt. Therefore, we have to convert it as debt, and that is what we are doing here. Okay, so can you scroll down? Now, we are using a part of that asset. Okay, on that we have to provide depreciation, and then say that amount of depreciation is calculated here. Okay, in row numbers 31 to 34. So this is also recorded. This should also be recorded in the free cash flow to the firm valuation model. Now let us go to the free cash flow to the valuation model inputs. Now, the first item is revenues. From revenues, we come to operating income or EBIT. Okay, revenues are shown against row 8 and operating income or EBIT shown against row 9. Revenues minus all operating expenses. Then interest expense. Now please see, do you have R&D expenses to capitalize? These R&D expenses would have been reduced from revenues to get EBIT of minus 216.60. Okay, now this R&D expense should be taken away from the this place in our calculation of the net income. Okay, in our calculation of revenues, and it should be capitalized. And that while you capitalize that capitalizing process, what is meant by capitalizing process? Convert it as debt. Okay, and that is done by say the R&D converter and operating lease converter. So R&D expenses and operating lease commitments are operating lease rentals are used as operating expenses, but we have to treat them as capital items. R&D will have to be converted as capital expenditure, and operating lease commitment will have to be converted as debt. That is what the R&D converter and operating lease converter do. Okay, because they should not, though accountants treat them as expenses, for the purpose of valuation, they should be treated as a debt and asset, because R&D is going to create an asset to you in the form of a patent, for example, or an investment. Therefore, the expenditure on R&D should be treated as capital expenditure, which will turn out to be a patent, which will create an asset for you. Okay. Therefore, it should be treated as capital expenditure. Accountants have their own reason. Accounting standards have their own reason as to why R&D expense has to be treated as a revenue expense. For example, the argument is the principle of conservatism. Okay. Don't estimate revenues, but record all expenses and losses. So to abide by the conservatism principle, accounting standards expect accountants to consider R&D expenses as operating expenses. But for the purpose of valuation of a company, it is actually capital expenditure. Therefore, it has to be converted as capital expenditure by taking out the R&D expenses from the total expenses that may have been deducted here from revenues to arrive at EBIT. Okay. Similarly, operating rents, operating lease rents, you have actually paid now. Therefore, treat it as operating expense, and in the years to come also treat it as operating expense. But what is an airline company actually doing? It might have hired an aircraft for 20 years, and the amount of rent that it would have paid over a period of 20 years may be equal to the actual cost of the aircraft that it has taken on rent. That means the rent that it is paying is actually the part of the debt repayment. That's how we can consider it. Okay. Therefore, and in the lease contract, if the total amount of debt paid, rent, operating lease rentals paid exceed a certain percentage, say 75% or 90%, it is possible to convert that operating leased asset as the firm's asset. Okay. Therefore, for all practical purposes, the operating lease commitments, rental commitments should be treated as the debt repayments, and the total value of the operating lease rental commitments should be summed up to arrive at the total value of de facto debt. Okay, it may not have been raised as debt, but it's a de facto debt. Okay, let us go to, that's what that slide explained. Okay, now and to do that, we have used operating lease converter and R&D lease converter. Okay, then specify the number of years before R&D can be expected to generate commercial products. Say we did, say it could be 10 years or 5 years. Okay, can you show the R&D converter? R&D converter is there if you scroll to the right. Yes. Now here, say we have written the R&D expenses of the past 5 years. Okay, and over how many years you want to amortize R&D expenses? It is 5 years. Can you please scroll down and see, show what is there? Okay, we have got the output, R&D expenses, amortized portion, amortization of the asset current year. Can you see something more? Can you show something else? Is there something else? Okay, no. Okay. There is another Excel sheet wherein the number of years that every industry generally takes to convert its investments in R&D into a tangible asset. Okay, I will get that Excel template and upload it to MS Teams. So for how many years we have to amortize, you can decide depending upon the industry. And what does the data tell us? That data tells us about the number of years which every industry takes to convert its R&D investments into tangible commercial, say commercial asset. Okay, an asset which can be used for the purpose of commercial exploitation. So from the day you are investing your money into R&D, you might require a certain number of years to convert it into a product. Okay, then only you can commercially exploit it. So in every industry, how many years are required for such conversion of your investment into commercially exploitable product? There is a data, okay, based on the number of years R&D investments have taken across different industries. So I will upload that data to MS Teams. You can go through that, or maybe in the next class I will show it. Okay, we will go back to the slide. Okay. Specify the number of years before R&D can be expected to generate commercial products. In that R&D converter, we showed 5 years. That number can be changed based on the number of years every industry takes to create a commercially exploitable products. Collect R&D expenses from the past. For the last one, 2, -1, -2, -3, you must have seen for that many years, and then amortize them. Straight line usually works. The remaining unamortized R&D from prior years can be considered the book value of the R&D asset, and operating income has to be adjusted by adding back the R&D expense from the current year and subtracting out the R&D amortization for the current year. Okay, so what is this R&D amortization and R&D expenses? Can you go to the R&D converter? In substance, the R&D expenses which are deducted have to be added back. What is that amount of R&D expense to be added back? That R&D converter will tell us. And what is the unamortized R&D has to be considered as an asset and to be entered into the value of assets. In addition to the value of assets which are already there in the balance sheet, we will get to know in that R&D converter. Okay, so we will see that Excel template of R&D converter, and that converter is to the right of a main input sheet. Okay, it is here, and please scroll down below. Value of the research asset is, say, unamortized portion is a $10,258. This year, what is to be amortized is a $3,490. Okay, because any investment capital expenditure can be amortized. That means it's like a depreciation. Okay, 3,490. Adjustment to operating income. Okay, that is minus 241.40. You have to deduct it. Okay, a positive number indicates an increase in operating income. Okay, if at all there is a positive number, you have to add it back. So what is the tax effect of R&D expensing? You are saving $68. Okay, so what is to be done with the help of this? Should we add? Should we deduct? Okay, everything will be told to us by this output. We don't need to do anything with this output. The main input sheet will take this value and consider it while producing the output. But what is the essence of this learning? Any amortization, okay, this 3,490 will have to be deducted from income statement. Okay, and after deducting this, should you add anything to the EBIT or deduct anything from EBIT will be shown by this adjustment to operating income against row number 39. If it is a positive number, we have to add. If it is a negative number, we have to deduct. Okay, it depends upon, adding and deducting depends upon how much amount we have amortized in a given year. What is the tax benefit we will get by doing this? That will also be calculated. We don't need to do anything with this value. This will be taken as an input by the main input sheet for the purpose of producing its output. And the effect of this will be shown in output. Okay, so let us go back to the slides. Okay, so let me repeat and conclude it. Specify the number of years before R&D can be expected to generate commercial products. say we wrote there 5 years. Collect R&D expenses from the past. Of the last 5 years, we took the R&D expenses and then amortize them. Amortization is done by the Excel template. The remaining unamortized R&D from prior years can be considered as the book value of the R&D asset. The value of unamortized R&D was shown by that R&D converter, and the main input sheet will take it as the input, and in the output sheet that will be used as an asset. This unamortized R&D will be added to the value of assets of the balance sheet. Okay. And operating income has to be adjusted by adding back the R&D expense from the current year. Current year's R&D expense will be added and subtracting out the R&D amortization for the current year. When we add back one R&D expense and deduct R&D amortization, then operating income will become either plus or minus. We saw that there, adjustment to operating income. It might become plus or minus depending upon the amount that you add back and the amount that you deduct. The amount that will be added will be the operating expenses of the R&D expenses of the current year, and amount that will be deducted will be the R&D amortization of the current year. Depending upon these amounts, the amount that you add and the amount that you deduct, the operating income will get adjusted. Put together, will it increase or will it decrease? Was shown to us by that R&D converter. In that example, it deducted. Okay. When operating income comes down, tax will also come down to the extent of tax rate. Therefore, what was a decrease in the tax rate? What was the amount of tax savings made? That will also be shown. Okay. That entire output will be considered by the output sheet of this Excel template of FCFF model to consider the value of assets. Okay. And the value of net income, value of the adjusted EBIT. Okay, we will go to the next slide. This is the next question. Operating income can be volatile both as a result of the normal ebb and flow of business and as a result of accounting transactions. Say, in 1 year, income might considerably increase, or another year it might fall down considerably, but it need not be the same. Okay, it need not happen always. Same thing with regard to expenses. Therefore, should you smooth or normalize operating income? And if so, how do you do it? So how should you normalize operating income? That is a question. Okay, if at all there is say volatility in the operating income. Let us look at the next slide. Normalizing earnings. We did normalize earnings in FCFE model, which was required there. Okay. Now let us find out the answer to the question. Should we really normalize earnings if at all there is volatility of earnings, that is volatility in EBIT and the revenues? If you plan to base your future operating income on current operating income, it stands to reason that you want to remove any items that are transitional, that is one-time charges or income, or cancel out over time, or for example exchange rate or pension fund gains or losses. Pension array when exchange rate changes, the value of your income changes. Okay, because if you have substantial income from a foreign country, when the exchange rate changes, the rupee value of your earnings, your revenues will also undergo a change. Pension fund would have been invested in stock market. When stock market prices undergo a change, the value of your pension fund also undergoes a change. Okay, it's a tougher call as to whether you should smooth out operating income by using the average income over time. For some firms, such as commodity companies, it clearly makes sense given the ups and downs in commodity prices over time. Commodity prices fluctuate widely, therefore you can normalize earnings. For other firms, especially those that are facing long-term structural or operating problems, you should not replace current depressed earnings with an average earnings over time. Okay. In the years to come, there are going to be problems for your firm, for your revenues. You know it very well. Then you should not average out the earnings. Instead, you should recognize that the earnings improvement, if it occurs, will happen gradually over time and reflect that in your valuation by a gradual improvement in operating margins. Therefore, how do we do that? We can take the industry average of the operating margin. Okay. It is quite probable that our operating margin might be quite high, but it may be momentary. In case we really know that it is momentary, then we can take the industry average of operating margin, because over a period of time, operating margin will smoothen itself or it will come down. Okay. How is it done by us in the valuation models? We will look at it. We shall first go to free cash flow to equity model. Okay. Now, come to row number 13. In row number 13, there is a question. Do you want to normalize the net income earning per share? Because there might be volatility in the net income or earning per share. If you say no, there is no problem. But if you say yes, how do we do that? There is another Excel template to the right. Second, if you scroll to your right, it is normalized earnings. Yes, second one. Let us look at that normalized earnings. You can use two approaches. Change the approach to normalized earnings. Choose the approach to normalized earnings. Approach 1 is average net income over the last 2 years. Approach 2 is a normalized return on equity. Okay, you can write either 1 or 2. Okay. Now, what does approach 1 do? It will take the earnings of the past 3-4 years. Okay, then average it out. Approach 2 is, it will take the return on equity of the last, say, 3-4 years and calculate. We have to write the normalized return on equity. Can you please, that is average return on equity will have to be shown here. Can you please click that red corner? You can either use an average return on equity for this firm of the last 5 years or an industry average. Okay, that input will have to be given by us. Okay, so if at all we say yes, if we have said no, there is no problem. Okay, so when do we say yes? In case we have perceived much volatility in the earnings, then we say yes. Okay, that's what we are supposed to do. Now let us go back to the slides. Okay. Can you go to the next slide? So that normalizing earnings is done by that Excel template. Okay. Now let us look at the next question. In computing the tax on the operating income, there are 3 choices that you can use: effective tax rate, marginal tax rate, and actual taxes paid. Therefore, there are 3 questions to be answered relating to this. Which one would you choose? Let us go to the next slide to find out the answer to this question. Let us start with what you cannot choose, what you cannot use: the actual taxes paid. Why not? The actual taxes paid will reflect the fact that you save on taxes when you make interest payments, because interest is tax deductible. amount of interest multiplied by 1 minus t. You will come to know the amount of tax savings. The problem, however, is that you have already counted the tax benefits in your cost of capital by using after-tax cost of debt, and increasing your cash flow for the same reason would be double counting. Therefore, we cannot consider the actual taxes paid. That rate at which we have paid the taxes, we cannot consider. Therefore, it boils down to a choice between effective and marginal tax rates. The effective tax rate is lower than the marginal tax rate for a number of reasons, but one reason is that companies defer paying taxes. Since this is a tax saving, there is nothing wrong with using the effective tax rate in computing the after-tax operating income for last year and even for next few years. If you use it forever, though, you are assuming that you can defer taxes in perpetuity, and that's a dangerous assumption. The best compromise is to use effective rates for the early forecast years and move towards a marginal tax rate in the later years. The marginal tax rate, say we have worked with the marginal tax rate in our calculations. Now let us see what we did in our calculation of FCFF. Okay, between FCFF and FCFE, I'm choosing only one. Okay, what we would have done in FCFF, we would have done almost the same in FCFE also. So let us go to that FCFE and see which tax rate is chosen by us. We'll go to the input sheet. Okay. FCFE, I think you are showing me, sorry, FCFF, please show. I asked her to show me the FCFF model because right in the beginning we see that tax rate. Look at the row 20 and 21, effective tax rate and marginal tax rate. We have written both the numbers. Now let us go to the output sheet and see what is actually done. Let us go to the output sheet. Please look at the tax rate, 25%. This is a marginal tax rate that is used. Okay, throughout. When effective tax rate is the same as marginal tax rate, it doesn't matter. Okay, but when effective tax rate and marginal tax rate are two different ones, generally effective tax rate can be used in the initial years and then marginal tax rate can be used. Now, can we use only marginal tax rate? Yes. Here we did not encounter any problem because effective tax rate and marginal tax rate were the same, 25%. But for all practical purposes, you can say that we will make use of marginal tax rate. Yeah. Is there any problem in making use of effective tax rate? No, in the earlier years. But therefore, in the event of confusion, which tax rate should be used here? We should use marginal tax rate. Okay. We'll go back to the slide. We will go to the second question. Next question. Okay. What happens if you are a multinational and are in several countries with a very different tax rates? Very good question. While some would push for an average tax rate weighted by the income in each country, I think it makes far more sense to use a marginal tax rate of the country the company is domiciled in as a floor. For example, marginal tax rate in our country is 25%, marginal tax rate in US is 21%. Therefore, use a marginal tax rate of the country in which the company is incorporated. That is what is meant by domiciled in. After all, income earned in countries with lower tax rates than the domestic tax rate eventually has to be repatriated back to the domicile, at which point it will be taxed. If my company is operating in those countries where tax rate is less, what do I do? Finally, a part of the income has to be brought back to my country. So when I bring it back to my country, it will be taxed there. That's the idea. Therefore, use the marginal tax rate of the country in which the company is incorporated. It is a tougher call for countries with higher marginal tax rates than the domestic. tax rate. Here it does make sense to use weighted average. If the marginal tax rate is higher than the domestic tax rate, we can use weighted average, is what Professor Ashwath Damodaran is saying. Okay, so marginal tax rates, say, for example, in my country, the domestic tax rate, there is a domestic marginal tax rate is 20%. In other countries, it is 25% or 30%. Then what do I do? Then I can do weighted average. For example, US is charging 21%, whereas India is charging 21%. Then what should American companies do? Well, how do you value, which tax rate do you use for the purpose of using tax rate in the corporate valuation? Use a weighted average. Okay, let us proceed to the next. What happens if you are reporting an operating loss? What is meant by this operating loss? Revenues, then we get operating income, isn't it? Revenues minus expenses, we get operating expenses, we get operating income. What if there is no income but operating loss, as we saw in that FCFF valuation model? In the year of operating loss, the tax rate used in computing the after-tax operating income and the after-tax rate cost of debt should be 0. As you project the earnings into future years and they turn positive, you first have to cover your net operating losses from prior years, during which period your tax rate will still be 0. When you use up net operating losses, your tax rate will converge on the marginal tax rate. What does this mean? Can we go to the free cash flow for firm valuation model? How is this theory is used? We'll go to the input sheet. Please see here in row number 9, operating income is minus. It is operating loss. Okay. Then what is to be done? You will have to enter the net operating losses. Okay. So that the tax effect on operating losses will be considered. It will be tax savings. So where do we record the net operating losses? Can you please scroll down below and show? Not, if at all there are losses this year, there might be losses in the previous years also. Okay, so can you please just above that, just above. Okay. Can you just go below this? Okay. No, it was in FCFE model, I suppose. Can you go to FCFE model? Can you just go down and see whether there is a net operating losses? NOL is written. Okay, I do not find it here. Okay, it was there in one of the Excel templates. Okay, that's fine. Fine. I will go back to the slide. I do not remember in which Excel template it is there. But in any case, so what is the conclusion? We will go back to that. We'll go back to the previous slide. Okay. No, next one, next slide. In the year of the operating loss, the tax rate used in computing the after-tax operating income and the after-tax cost of debt should be 0. As you project the earnings into future years and that turn positive, you first have to cover your net operating losses from prior years, during which your tax rate will still be 0. What does this mean? Say in this year there is a net operating loss, then should you pay tax on that? No, because it is loss. But in the years to come, you will have you will project your earnings, your revenues, they will be positive. But there is one rule in Income Tax Code, Income Tax Act, which says that prior years operating losses can be set off against future years income. In that, during that year also, during those years also, tax rate will be 0. Okay, but after that, when you use up your net operating losses, what does that mean? You have set off your net operating losses against net operating income. Your tax rate will be the marginal tax rate. So what is the essence of this discussion? If at all there are net operating losses, in the years in which there are net operating losses, don't use tax rate. Of course, in that FCFF model, it does not use the tax rate. Okay. It does not levy tax in the year in which there are losses. We can input the effective tax rate and marginal tax rate, but the Excel template, the micro is structured in such a way that it will not levy any tax in a year in which there are operating losses. If at all the EBIT is shown in minus within brackets, it means there is loss. In that year, tax will not be levied. But when net operating income is shown without brackets, which means that there is income, the EBIT is plus, in other words, operating income is plus, the tax rate will be used by the Excel template for the purpose of deducting tax. Okay. So this is about the operating income and the use of tax rates and the related questions. The theoretical underpinnings regarding calculation of operating earnings, reporting it, and the use of tax rate, I have explained. I will take up remaining questions in the next lecture. Thank you.